Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 11th of April. It's still 2023, and we have a big report coming up. It's the CPI, Consumer Price Index. That'll be on Wednesday, but we're not done yet. That's a W. On Wednesday, we have the PPI. PPI is going to be your Producer Price Index. A little bit more information, but the Fed's going to be watching your core PCI. PPI comes out on Thursday. And if we're not done with that, Friday, we have industrial production and separately retail sales. So all these things are coming out in the next trading sessions. Let's get right into it. What's the market pricing in for all of these potentially big market movers? And the other question is going to be, will one of these, CPI perhaps, so the core producer price index or inflation rate, might that be a catalyst to punch the market up to here? Or as I'm thinking, maybe a catalyst to take it right back, as it has done each time it's been into this 4,200 level. That's the game plan, at least, as we see it. Call the balls and the strikes as an umpire does, and set the trades up from the logic. So that's going to be your, I call it dominant thesis, but anything can happen. Let's see what the market's pricing in before we start making any other predictions. Number one, let's take a look right here. This is our S&P. In fact, let's do it for the SPX. It'll be about the same. So we're looking at a 39, a 50, and a 59 for the next trading sessions. What does that say about the SPX? The numbers will be a little bit different out here, but we'll take a look at this because it might be a little better forecaster of the volatility. What are we looking at? So for Wednesday's session, again, Wednesday will be the CPI, the market in terms of the SPX, pricing in a, right here, a 38, let's just go 39, expected move. And on Thursday, we'll have the PPI. On Thursday, the market, at least until those sessions, we'll know after Wednesday, but it's all built in, at least by the time of this video, pricing in 50 for those two sessions right after CPI. This could go down. And by Friday, the market's pricing in about a 58 as we speak, or as the ball lies on the field. This could change rapidly. And just because it says roughly 40, if we get a double, a super expected move, or a double the expected move, that could push the market up to 80. And that could be plus or minus, just going into the next couple of trading sessions. So what could be the catalyst? Right here is CPI. What is it pricing in? What are we looking at? CPI is your inflation data. I can't draw the tool, so I have to look at it this way. What we're focusing on is your month over month. There's three things we're looking at. And if you've never read a CPI report, you're not alone. Most people haven't. But what we're looking at is the headline number and what it says about inflation. And it says if the number is to be the key, it will be coming down. Inflation coming down is a good thing for the market. And that means the Fed probably will not raise rates anymore. And if they do, it'd be just one additional rate hike in 2023. And that's if they raise them one more time. If inflation comes down, the odds of a rate hike also come down. Oh, the Fed minutes, by the way, speaking of, the Fed minutes will come in on Wednesday as well, as if there wasn't enough to pay attention to as traders on the next few sessions. If we thought today was boring, the next few sessions ought to bring some spice and volatility into the market, especially on the intraday charts. Back to this. So we're looking at the month over month. Let me translate all the CPI, Consumer Price Index, month over month change. It was 0.4, so 0.4% month over month. They're expecting a decline, still inflationary, still inflation's going up, but a change of not 0.4 anymore, but 0.3. Still inflationary, but a little bit smaller, a little bit less inflationary. I'm going to have my eye on this, which is CPI year over year. And what is that? Previous, again, year over year, has been as high as around 8%. We're down from the 8%, and previous year over year report, 6%. The expected, again, consensus expectation, generally speaking, here in thinkorswim on their Analyze tab, Market Watch, is 5.2%. Still inflationary, but not as much. And if you take out the food and energy, looking at a 0.5, 0.4. We won't go into details on those, but nonetheless, we'll be watching these. It's just a price level of a basket of goods and services produced by or purchased by consumers. And we'll go over to the PPI. Also have jobless claims, so PPI will be over here. CPI, PPI is going to be right there. Similarly, there is PPI, Producer Price Index. Not as impactful as CPI. And if we're not done yet, we have retail sales. Previously, retail sales were down just by a little bit, and the expectation is they'll stay about the same. Take out vehicles. Vehicles are a little bit volatile. Food and energy prices are volatile as well. So they get the core inflation. That's what the Fed tends to watch, at least recently. But back to retail sales. Take out vehicles, and you're going to see a decline potentially in retail sales. So these things, as we say, Don and us here in the team in TheoTrade remind you, sometimes bad news is good news. So if retail sales come down, that could be a good thing for the market because it does set in motion the need, or the necessity, I should say, for the Fed not to raise rates and hurt the economy even more. If the economy is going down, why help it? Higher interest rates help the economy go down. And that was a large part of 2022, especially in the tech sector. So that's just on the docket, not to mention stocks that have earnings. Which ones have earnings? Just in the next few days, BlackRock, Wells Fargo. These are on the next 3 trading sessions in the future. So later in the week, again, this is a Tuesday night video, so we're talking Friday here. But Wells Fargo, JP Morgan, Citigroup, United Health, and the next week will be Lockheed Martin, Bank of New York, Goldman Sachs, Bank of America. So as if, I keep saying this, but it really is true, as if there's not enough this week, we have financial earnings to focus on later this week and into next week. So what's priced in there in terms of the implied volatility? Not big movements, but we'll be watching those. Individual stocks will certainly have a little bit higher or elevated short-term or near-term expected moves. That includes Wells Fargo, Citigroup, JP Morgan, and the others. We'll actually throw in UNH, United Healthcare, Lockheed Martin, and these will be actually next week for their earnings. So what's the big picture? What's the big play? We still have the session. We call it here at TheoTrade bifurcation. What is a bifurcation? Bifurcation is when the technology sector and mainly, and we say technology sector, it's actually Microsoft and Amazon. Microsoft was down 2% today. Amazon was also down 2%. The advanced decline stayed the bulk of the session well above 200. In fact, it stayed above 300 for the most part. But the Nasdaq stayed negative all day long because of the mantras of tech. So on a visualization, it makes more sense. Big picture, and this is where we're being split in the market, and your swing trades are being affected by that the tech sector is going lower. We'd expect that. That's some of the trades we have in the bear positions in some leading technology companies, and they're going down. But that's being countered by other, not even big companies, but a smattering, a large number of companies going bullish. And that's across the board. That's all your sectors were up today. Generally speaking, more stocks were up today. And the S&P was up, and at one point the Russell was up about 1.5%. So these are being pulled to the upside. And as we like to say, the S&P splits the difference between the Russell, which is 2,000 small cap stocks being very, very bullish, the Nasdaq, which is, let's be honest, 6 stocks and only 6 stocks that were bearish, and the S&P being a little bit of the bull and a little bit of the bear, split the difference. Russell was up 0.7% or 0.7%. Nasdaq was down at over 1%, and the S&P right through the middle. And that's the going thesis. And the financials, that's a little bounce to the upside. There is your technology coming off. Again, if you look at some of the leading stocks, that is the play. The play is down from these overextended levels and from the prior resistance. That's going to take us into CPI with a potential move even lower in the XLK. Stocks we can look at specifically or individually have similar patterns. There is Microsoft, the big leader in the market. Amazon right behind it, which itself has a bear short sell position down from about 104. And NVIDIA, coming off of its extended high just shy of 280. And then we'll look at Google or Alphabet similarly coming down. And Apple is the biggest stock, but it's just a simple pullback from its overextended levels as well. That's putting pressure on the broader XLK. And to an extent, not all the sectors are in the same position. So just quickly, there's the I, industrials, B, materials. E is your energy. Crude's actually getting another bid and was up on today's session 2% back into the top of its trading range. P is staples, again at the middle. V is healthcare. Not a lot to say about it, but utilities did get the bounce play from that 64. Outside of it, gold was down and continues to pull down away from its 2005 or 2050 per ounce back into 2000, and we see it bounced slightly off that 2000 print with a potential, if you look at the weekly chart, to go a little bit lower. Crude on the big picture is simply getting a pullback or a bounce or support bounce oversold rally from its 66 or 65, almost 70 per barrel print. And the dollar index almost at session lows. Quickly noting the bond market is back at the highs, like the S&P. This is our weekly perspective, but just take a quick look that the bond market off the daily perspective, which is right here, the daily perspective, is in a similar spot to the S&P. So CPI will be tomorrow. That'll be the big catalyst, but the bond market could push lower. That means yields could push higher. And the stock market equities, looking at this on the S&P and others, are in a spot to trade down once again. This could be the reward pathway, as the same logic from the overextended sells, but that's not a prediction. It is a reward pathway up against a risk pathway, and the risk pathway would be if the CPI is a little bit cooler than expected and those retail sales on Friday are a little worse than expected. I know, bad news is good news, but that S&P could travel the risk pathway to 4,400. We will see. Always be careful and safe. This is Corey Rosenblum with tonight's Theo video update for April 11th, 2023.